Okay guys, in today's video I just want to take you through a quick trade example. This one was on the Turkish ETF TUR and it was the short straddle, so let's take a look. You can see here that from March through to May the ETF got absolutely crushed, down about 30% or so, down from sort of 44 down to about 30. So getting absolutely crushed. It did have a bit of a bounce here back up to 33, 34, which is actually when I entered the straddle. So the entry wasn't the best, would have been better to enter down here when it was at 30, but such is life. So anyway, entered when it was at 34 and then pretty quickly dropped down to 28. So on a neutral trade, that's not ideal. Did bounce back up to about 31.50, but then again, really quickly dropped down to 26 even. So I'm going to walk you through the trade and show you how it worked out. As you can see here, volatility was really high, so we're up around 45% at the entry. So that was the main factor in deciding to do a short straddle, which is of course a short Vega trade. So highest implied volatility level that we've seen in 12 months. So definitely wanted to be short Vega at this point. So here was the trade. It was May 30th. Underlying price was at about 34. Sold two of the July 20th straddles at 34. So just slightly below the market. Premium received was about 820. So here you can see the payoff diagram. Break-even points are at about 38 on the upside and 30 on the downside. So, we can withstand a pretty decent move because implied volatility is so high. You can see here it's up at 41.5%. Moving forward, and by June 13th, the trade was under a bit of pressure with TUR dropping to 29.72, which was pretty close to my initial break-even point, if you remember from the previous slide. And this was also the adjustment point that I had set. And the way I adjusted was by adding a second straddle. So here you can see June 13th, we're at 29.72. And I've added a second straddle, same number of contracts, slightly below where the market was at the time, and got another 730 in premium for doing that. Now it has added a bit of risk to the trade because I'm selling more contracts now. Remember, these are naked options with straddles, so not appropriate for everybody. Make sure you trade according to your own risk tolerance. So let's change the structure of the trade to more of a strangle type shape. And looking back at it, what I could have potentially done was do it a little bit more differently. Rather than having two straddles, I could have just turned it into a strangle trade with the short puts at 27, the short calls at 34. Because what I've done here is I've given myself a little bit of early assignment risk. Luckily, I didn't suffer any early assignment, which wouldn't have been a huge deal, but prefer not to have that sort of headache. So that was what the new structure looks like. Again, I've reduced the break even on the downside to about 26 now, where previously it was at about 30. I've reduced the profit target in the trade a little bit. At this point, I was down about 300 bucks on that initial straddle. Income potential from here is about 450. So, best case scenario, if TUR finishes between 27 and 34, I'll come out with a small profit of about 150 bucks or so. At expiration, TUR closed at 27.97, so right within my structure, which was great. Resulted in a net profit of $160. Not a huge profit in anyone's view, but certainly not too bad for a neutral trade on an ETF that dropped 18%. So hopefully this adjustment strategy for short straddles may not be for everybody, but hopefully I've demonstrated to you that it is possible to still achieve a profit even when the underlying makes a big move. In this example, we achieved a small profit, but we did add more risk to the trade in terms of adding more contracts. So it may not be for everybody, but as I said, we were able to come out with almost a wash trade with a small profit by adding to the trade on the downside. And finally, I want to leave you with some words from Dr. Russell Richards regarding this type of adjustment. When scrambling to manage a losing trade, especially a losing undefined risk trade, most traders are happy to exit the losing trade at a wash or even a small loss. You'll have to decide what is appropriate for you, but don't get greedy when managing losing trades. So you wouldn't want to just continually add to this trade. Like if it continued going down and started to hit sort of 20, you wouldn't want to just be continuing to add straddles. So keep that in mind. But in any case, hope you enjoyed this video. Let me know what you think about this trading strategy in the comments. And if you've tried short straddles in the past, let me know what your experiences have been like. Thanks, guys. Have a great day.